I'm Samantha Deitcher for InvestmentPitch.com. As we approach the end of the calendar year, we see an increase in the number of flow-through shares being offered by resource companies. But what exactly are flow-through shares and what is their tax treatment? Resource companies are allowed to deduct expenses for prospecting, sampling, drilling, and other costs. But if they don't have any revenue, these deductions are effectively wasted. In a rare moment of generosity, the federal government, more than 2 decades ago, created legislation to allow certain companies to pass on these deductions to taxpayers that can use them. This was designed to stimulate mineral exploration in Canada and improve access to capital for small companies. By issuing flow-through shares, a company gets greater access to money to finance its exploration work, and the investor can claim up to 100% of his investment as a tax deduction. To access these credits, an investor purchases flow-through shares directly from a resource company, and the resource company uses these specific funds to incur qualifying Canadian exploration expenses, or CEE. This sounds pretty clear, but let's look at an example. An investor purchases 10,000 flow-through shares at $1 per share, getting to write off his full investment of $10,000 in the year he purchases his shares. This write-off can also be applied to both previous and future tax years. After the write-off, his shares have a zero cost. However, when he sells his shares in the future, the total proceeds are taxed, but at the lower capital gains rate, whereby only 50% of the gain is taxed. If our investor is in the top tax bracket, which is 43.7%, he would get a tax return for $4,370, 29% from Ottawa and 14.7% from Victoria. The potential return gets even better, because in 2000, the federal government announced a 15% non-refundable investment tax credit, which unfortunately applies only to mineral exploration companies, excluding oil and gas exploration companies. Many individual provinces have since initiated their own additional tax credits, which vary from 5% to 30%, with British Columbia having a 20% tax credit. Therefore, if we assume our investor is a resident of British Columbia, he will receive an additional $2,000 from Victoria and $1,200 from Ottawa. These write-offs and tax credits bring his original $10,000 cost down to only $2,430. With a non-refundable tax credit, a taxpayer has to pay taxes in order to use these claims, which is usually not a problem for any investor in the higher tax brackets. Let's assume that in the following year, our investor sells his 10,000 shares for $1 per share, which was his original purchase price. With only 50% of capital gains subject to taxes, our investor only pays tax on $5,000 of his profit. Remember, his share cost was reduced to zero. He therefore pays a tax of $2,185, which is 43.7% of the $5,000, with $1,450 going to Ottawa and $735 to Victoria. Unfortunately, the 2 non-refundable tax credits, which were received in year 1, are taxable, so $1,400 must be paid back in taxes the following year. Having received a total of $7,570 in refunds in the first year, and now paying back only $3,585 in year 2, our investor now has an extra $3,985 in his pocket, which is the difference between his after-tax cost of $2,430 and his after-tax proceeds of $6,415. This is an after-tax profit of 164%. Let's assume the market wasn't too kind for our investor, and he only gets $4,900 when he sells his shares. Again, he only pays tax on half his profit, totaling $1,070 in taxes. However, you will notice that the additional taxes on the non-refundable tax credits remain the same as the first example, as they are based solely on the previous year's tax credits and unrelated to the proceeds from the sale. As our investor only has $2,430 at risk, after the tax refunds on his original $10,000 investment, when he sells his shares for $4,900, ending up with $2,430, he can break even. Therefore, a taxpayer in British Columbia can lose one-half his investment and still break even, while benefiting from the deferral of taxes. There are a couple of other things for you to consider. For example, most flow-through shares are purchased as a private placement, which are subject to certain restrictions and usually can't be sold for 4 months. It is also possible that, in a rare instance, the resource company doesn't spend the funds correctly and in the required time period, which means you could end up with a future tax liability. As the tax treatment of flow-through shares is quite complicated and varies between the different provinces, please consider this information as only a guideline and consult your financial advisor or accountant for specific advice. I'm Samantha Deitcher for InvestmentPitch.com. For more video news and to view our disclaimer, be sure to visit our website, InvestmentPitch.com.